So today we're diving into a topic that sparks quite a lot of debate: wealth taxes.
And of the rich just not paying their fair share.
About multimillionaires, billionaires to pay a bit more in tax.
Tax wealth, not work. Give these people a break. Give their kids a chance.
The question I'm tackling is straightforward yet complex. Do wealth taxes actually work? Now, I've been hearing a lot more in the news about the application of wealth taxes in the UK. And I've been thinking, actually, is that a sensible thing to do? And I wanted to stay relatively unbiased on it in this video to look at the facts. What countries have actually introduced wealth taxes in the past? Which countries have then rescinded those wealth taxes? And which countries keep wealth taxes as part of their taxation policy? And the reasons why across all of those different countries. Now, we're looking at 5 or 6 different countries as we do this, particularly those that have got developed economies, to see and compare, so it's more similar to a comparison to the UK. It's a country by country review. It's grounded in facts and figures where it can be. And although I do add some personal opinion, it's not flavored by that too much. So a net wealth tax at its core is a recurring tax on the total value of an individual's assets minus their debt. Unlike taxes on specific assets like property or stocks, this targets the entire net worth. The goals stated are often things like to reduce wealth inequality, generate government revenue, and to foster a sense of social contribution from the wealthiest people. But does it really work? Now, historically, many developed nations have explored wealth taxes. The mid-1990s saw the peak of this activity, with 12 OECD countries reporting having wealth taxes in place. These included nations like Austria, Denmark, Finland, France, Germany, and even Sweden. Even some non-OECD countries like Argentina and Colombia have given them a go as well. The trend since then has been quite telling: a significant decline in the number of countries that have a tax on net worth. So let's take a look at some of the specific examples of the main countries that introduced wealth taxes and then crucially repealed them from their tax policy. As you can see, the list of countries that once had wealth tax in place is considerably longer than those that still do. Why don't we delve into why many of the countries decided to reverse the course on wealth taxation? So let's take Austria. It abolished its wealth tax in 1994. The official reasons cited were high administrative costs and the economic burden on business. The revenue generated was quite low, about 0.2% of GDP for wealth taxes in general. Denmark followed suit in 1997, while specific official statements are less detailed. In the research I did, at least, the common reasons for repeal are likely applicable here, including low revenues, high administrative costs, and capital flight, and damage to economic growth by taxing capital. Interestingly, the research suggested that while wealth inequality stabilized after the abolishment of wealth tax, the wealthiest individuals continued to grow their wealth over time. Switching to Germany, it was repealed in 1997. It was triggered by a ruling from their constitutional court, and that deemed the tax unconstitutional due to preferential treatment of real estate. The tax also brought in a very small share of revenue, just 0.1% of GDP. Moving to the Netherlands, they repealed their wealth tax in 2001. The key reason, or one of the key reasons, according to the government, was capital flight. More recently, in 2021, their Supreme Court ruled the existence of a wealth tax as violating European law on property rights. Looking at Finland now, they ended their wealth tax in 2006. They cited unfair impacts on enterprises and significant opportunities for tax evasion. The general concern was about the low revenue, and the impact on economic growth also played a part. Iceland initially repealed its wealth tax in 2006, but they introduced it or reintroduced it between 2010 and 2014 as an emergency measure during their financial crisis. This temporary tax raised about 0.3% of GDP annually. Moving to Luxembourg, they repealed their wealth tax for individuals in 2006. They have maintained wealth tax on legal entities, but even that's faced a recent unconstitutionality ruling in 2023. Moving towards Sweden, they abolished their wealth tax in 2007, largely due to capital flight and the departure of prominent business figures. They considered those as major factors. The tax was also seen as potentially regressive and leading to significant tax avoidance. The revenues were also relatively modest, of 0.4% of GDP. Finally, looking at France, the last major country to have a net wealth tax repealed. It was repealed in 2018. They replaced it with a tax on real estate wealth. The aim was to encourage investment on the real economy and address concerns about hindering economic development. Capital flight was also a significant issue, and the tax raised was relatively small, relatively modest at 0.17% of GDP. Now, across all of these countries, these case studies, there's several common themes that emerge. Firstly, the administrative difficulties and high costs associated with valuing net worth, but also collecting the tax. These are major hurdles. Secondly, the low revenue yield from a wealth tax often doesn't justify the complexities. And thirdly, the concern over capital flight and brain drain is a recurrent motive for the repeal. Now, policymakers also worry about the negative impact on economic growth and investment, and in some cases, legal and constitutional challenges have played a role. Finally, the argument of double or even triple taxation on wealth that's already been taxed has often been raised. So despite the trend of repeals, some countries still levy net wealth taxes. These include Norway, Spain, Switzerland, Colombia. Each has its own specific system and rates. The debate about wealth inequality and the role of wealth taxes clearly continues. Challenges like international tax avoidance and the potential for global minimum wealth tax are also part of this ongoing discussion. So what do objective reviews of this from organisations like the OECD and IMF say about wealth tax? Well, they've analysed the experiences across the different countries with wealth taxes. They've noted concerns about efficiency, administration, and their frequent failure to significantly redistribute wealth. They suggest that broad-based capital income and taxes and inheritance taxes might be more effective at doing this. The IMF also highlights the complexities of implementation, particularly the asset valuation of wealth. And while supporting progressive taxation, they suggest focusing on strengthening capital income and property taxes. More broadly, academic studies on wealth tax have explored their impact on wealth accumulation, capital flight, and economic growth. The findings are often mixed, and that depends on the specific context of the report and often the authors. Some research points to a relatively modest migration of wealth out of the country, while others point to significant capital flight. So let's wrap up. Do wealth taxes actually work? Well, the historical evidence suggests they face significant practical challenges. Many countries abandon them due to administrative burdens, low revenues, capital flight, and concerns around economic growth. A few nations continue to implement them. Their effectiveness does appear to be highly dependent on the specific design and the broader economic and political landscape in that country. Now, international organizations often express a lot of caution around introducing wealth taxes. They suggest alternative approaches to addressing wealth inequality would likely be more successful. So what's your opinion on wealth taxes? Are they good for the United Kingdom? Are they bad for the United Kingdom? Let me know in the comments below, and thank you for watching.